Hello and welcome to Switzer Investing TV. I'm Peter Switzer. This is a really important show with the US election coming up on Wednesday, our time, Tuesday in America. Cup day on Tuesday for us, and the punting or the gambling on the stock market continues with the US election. I'll be talking to June Liu of Tribeca Alpha Plus, Paul Rickard from the Switzer Report, and Ryan Quinn from our company called WCM, which have two stocks on the market. One is called WQG, another one is WCMQ. I'll be talking about what he sees for investing in the future. And this has been a very successful performing fund manager if you want exposure to overseas. But without any further ado, let's go and catch up with June Liu of Tribeca Alpha Plus. Thanks for joining us, June Liu.
Thank you for having me, Peter.
All right. Now, I don't usually talk to you about politics, but you can't escape the importance of the US election, whether Donald Trump wins or Kamala Harris. As a fund manager, how are you viewing the threats and the opportunities of the US election?
Absolutely. Look, it is so often talked about, most important event on the calendar. As a fund manager, we kind of just look at this and more as an opportunity, because when you look at the performance of the share market as a result of election, usually they have very limited impact on the share market unless their policy has some sort of economic impact, whether it's tariff or other things. So net in general, they get washed out very, very quickly. So if there's a sell-off on the day, it's fantastic buying opportunity. Now, with this race in particular, everyone's saying all the political commentators saying it's too close to call. So, obviously a lot of people waiting, thinking if it's a Trump sweep and won everything, then there's every chance there will be a very cyclical rally. But my view is that regardless of which side, we will have cyclical rally coming through, just because the rate cut cycle is coming through. If it's Trump, yes, we'll have a bit more stimulus in terms of tax cut than others. But then, if you have high tariff, will be on the other side. So look, I think net, this will be a great buying opportunity should there be any sell-off.
Okay. So what you're saying is, let's face it, we know the market went up, but it was a negative week for US stocks, a negative week for us. Was that a bit of pre-election uncertainty, fund managers taking profit ahead of the election, and then probably thinking like you, once the election's over and we know who's going to be president, well, that's going to be a reason to buy into a rally?
Yeah, I think so. So there's always people want to be a little bit more cautious ahead of the election, because as we said, even though we know there's no long-term impact from election, but short-term could be volatility. So people want to hold a bit more cash so that they can buy should that volatility come.
You're not worried about the implications of, because you said if Trump gets a clean sweep, that would be a good thing. But wouldn't that mean that, well, it would mean that he gets his tax cuts through, which the market would like. But what about the question marks over tariffs? Do you in many ways think that his threats around tariffs are probably not going to come to the aggressive reality that they sound like they might be?
Yeah, absolutely. I think that's very much it. I think these threats will remain as threats. So if you look at last time, what happened when he rolled out all these tariffs, he did get some of them through, but it's way rolled back from what he initially suggested. So right now he's talking about 50% on a lot of tariff. It's going to be wind back, if any. So, I do think there'll be tariff, but nothing as what's being played out to be at the moment.
Okay. All right. So has there been any Australian stock that you've bought because you thought there would be a positive US election effect?
Yeah, well, there's a few of them. I think, the the blue scope is the one that we did look at as a very, very strong cyclical recovery business. Not so much just election. It's really about, the earning itself is being cyclical low at the moment because it's still dynamic and everything else. But anything forward looking, it certainly looks like it's very, showing green shoots. It did recently had a downgrade, but that's very, again, backward looking. So I think look forward, things will look better. And of course, once the election pass through the way, or the US manufacturing and a lot of those policy direction is very positive for this business. So and there's a high quality management team, and also exposed to somewhat the housing market here in Australia as well. So we think that's a good buy for a cyclical low earning. It also gives you that buzz should the election go through, as people expected.
Okay, it seems to me, Jumbo Lou, what I'm hoping for is I don't really care who ends up being president, but I don't want a clean sweep because I kind of like the environment that we've been working in for the last 4 years. I think under the Biden regime, the market was up about 63%, and I'm kind of hoping that, okay, if we don't have anything really crazy, we'll see maybe more interest rate cuts because tariffs would worry the inflation. People out there, people worried about inflation, and maybe the central banks would be hesitant to cut aggressively. But I'm hoping that 2025 is characterized by something you implied, interest rates coming down, but also, and this is the question to you, are you still a strong believer in China making a comeback over 2025?
Yeah, I do think so. I think China would definitely make a comeback, but may not be the hockey stick as we are expecting or we are hopeful, but it is certainly showing sign of improvements. I think this week we're expecting a bit more stimulus to come out, maybe not a big stimulus, but still there's more to come through. And we see its consumer is turning its corner. The housing market is less bad. So by next year, things should get better. Maybe it's not the 4%. So, you'll probably get to the, between 4 and 6, maybe it's a 5% growth next year. Regardless, it's better, much better outlook than what it has been in the last couple of years.
Yeah. Are there any other themes that you're interested in right now that is driving your interest in certain companies? You underline BlueScope, looks like a buying opportunity because you believe there's going to be an improvement in the economic cycle over 2025, 2026. Are there any other companies that are either fitting that particular theme or some other theme like artificial intelligence?
Yeah, absolutely. So there's quite a few themes. So one of the cyclical theme we talked to, company will benefit from falling interest rate, particularly in the US. That's interest rate is already falling. One good example is James Hardie. One of the highest quality company, growth company. Of course, got hit with a few headwind in terms of rapid rise in interest rate and mortgage growth slow. And the earnings that's coming up, is expected to be a bit weak, but that will be very backward looking. Because looking forward, we're already seeing the mortgage application getting better, and in the US, with the minute we had the 50 basis point cut. So that's one company that looks interesting. We think the artificial intelligence AI space is very fascinating. There are so many ways to play it, but often it's difficult to buy them on a dip. So whenever there's market volatility, you want to buy them. So there's a number of them that sort of play into that theme. You've got the likes of Goodman Group, you've got the NextDC, but one good interesting one is Infratel. Infratel also has a very big exposure to the data center business in Canberra, and it's actually less talked about because it's a New Zealand company. It's less liquid, and there's chances are it will be including the MSCI this week, so it could have a potential catalyst coming through as well. So that's a good one to play, and a number of other business like Pro Medicus play into that whole cloud thematic.
Okay, so what's the ticker code for Infratel?
IFT.
IST.
Oh, IFT.
All right. Okay. So one final group. Now these are what I've always regarded as tech companies of the future. They're not like NextDC. They're not like Xero, who actually and Seek or car sales or REA, who've proven their quality over time. Audinate and Megaport. we have people in our subscribers who keep asking, should I stick with these companies? Will they come good? What's your view on those two companies?
Yeah, I do like both of them. They obviously going through their challenges. I think, Megaport is the one that if you take 12-month view, you certainly can see things will get better. They hired a whole lot of salespeople. They changed, they got a new management team that's been in place now almost 12 months. And I think, they are showing things will get easier in terms of comparables, but, it's just taking a bit longer. I think, by latter part of this financial year, we'll see better earnings momentum out of Megaport. With Audinate, clearly things being a bit tough. I always like this per company long term. In the short term, it's just sitting, what do they call it in the small cap, market? They call it sitting in the sin bin because the number of downgrades that they had. Look, you need to give it 6 months. And then from then, certainly things look like it's getting better. And unfortunately, it's one of those characteristics sitting in the small cap where, used to be a favorite stock and then now sort of sitting in the sin bin. I do like them both, but you need to be a little bit more patient with both of them.
Okay, but this is the kind of question I get, Junbo Liu, and you don't get it because you're not really dealing with subscribers. But are they in the sort of the price zone, which is good for dollar cost averaging? A lot of people have bought them at slightly higher prices, and they're wondering, should they buy more on the basis that if they're willing to wait 6 months or 12 months, they'll be quite happy with the average cost base that they'll have for those companies?
Yeah, I think at the moment the prices look very reasonable for both of those businesses. It's not pricing in much earnings growth because, especially after the downgrade for both of them, analysts are pretty pessimistic. So you're not paying for big growth numbers. So to me, it's pretty safe. It's just probably not going anywhere for some time until we have a clear catalyst. Investors like to see catalysts where it's coming from.
Yeah. Well, fortunately for the people who are asking these questions, investors, people running a self-managed super fund, unlike you, where you have to perform and show great results, at least on a quarterly basis, but they can wait. They can wait 12 months. They can wait 2 years, as long as you believe that they are quality companies. And that's what you're saying. You do believe that they are quality companies. And I guess over time, they will become quality tech companies that we can rely on.
That's right. Absolutely. That's very true.
All right. Great to see you, Junbo Liu.
Thank you very much, Peter.
So that's Junbo Liu of Tribeca Alpha Plus. And there was Junbo Liu of Tribeca Alpha Plus. I'm now catching up with Paul Rickard of the Switzer Report. And I'm going to continue the theme around Donald Trump or Kamala Harris and how he was going to invest either before and or after the election. Paul, what do you think is going to happen and how are you going to invest?
Well, I think what's going to happen, Peter, is pretty close at the moment to know. I've got a feeling Kamala Harris might get in just because of some of the late polls, but who knows whether the argument's been that the polls consistently underestimate Donald Trump. Have they corrected enough?
Yeah.
Overcorrected? Question mark. So there's some signs in the last 24 hours that maybe there's going to be more women are going to get out and vote, and that might be better. But look, who knows? I mean, there are the markets and the bookies clearly have Donald Trump as favourite, and so I think the going in proposition is that at least the markets believe he's going to win, and they're probably more positioned for him winning. And I think that would be seen by the stock market community as being a positive for stocks. Whether they've already bought ahead of it, I don't know, Pete, but that's always the hard question.
Yeah. The betting businesses, are they good at this? Do they get it right?
Well, it's only a money business, so I mean, bookmakers don't sit there and actually work out
the way the money,
just the way the money flows. And of course, the more money that goes on Trump, then the more he becomes the favourite, and vice versa.
So he was 2-1. Kamala Harris is 2-1. So that's like an outsider.
That's like an outsider
for politics, yeah. And now it's 6-5.
It's certainly narrowed, and I think that maybe that's just nerves too amongst the
bookies,
and the fraternity that have bet. But lots of factors, including turnout and composition. So that poll that came out on the weekend in Iowa, of all places,
which is usually Republicans.
Usually Republican, very credible source. It's only a small poll. It's only 808 people, I think. But that was the total turn up. And so the particular pollster has bet I think it's her reputation on it. So That would be the surprise. If that happens, then Harris is going to win.
Yeah. My view is that if either one of them get a clean sweep, the market will be nervous. Is that a fair call, Paul?
Yeah, I mean, so just the clean sweep obviously is winning not just the presidency, but both houses of Congress. And of course, that means they have unfettered power, but they have a lot of power.
Yeah.
Whereas the normal stalemate provides, and that means that actually the houses have little power, and nor does the president, right?
Yeah.
So, and the markets seem a bit more comfortable with that, because it means they can't do anything crazy. Or
particularly on taxes.
Particularly on taxes.
But the thing that surprises me about the US political system is the president can raise tariffs without any need to support. That worries me a little bit with Trump and what he's been threatening.
Yeah, and so the argument goes that he's going to be inflationary and grind the US economy to a halt. Against that, tax cuts, deregulation. I think the markets think that that's probably, that fear is a bit overdone, and
the tariff fear.
Yeah, and they're more looking at the fact that look, he is going to boost oil and gas. He's going to be deregulate a lot of stuff as he's want to do. And it's just going to be because of tax cuts and talk about the continuing, corporate tax cut. He's going to be more sympathetic to business, and that's going to be better environment for share prices. And that's what the market believes. Yeah. And whereas, the Democrats allegedly big taxing and probably a bit more interfering in terms of things like in terms of the, big tech might be worried about the Democrats starting to interfere a bit in how they are governed. More talk of breaking them up potentially.
Bitcoin players like Trump. Yeah. Trump now likes Bitcoin.
He likes Bitcoin. So
he obviously invested in Bitcoin.
I think net the market's reaction, whatever it is probably going to be fairly, muted.
Yeah. I know Junbei Liu, who was on before you, she was saying, well, if the market sells off, it's going to be a buying opportunity from her point of view.
When I say muted, it doesn't mean it won't be serious for a couple of hours or a couple of days. Yeah. But I think when in a month's time, I'd be surprised if we're still talking about the US election too much.
Yeah. My only fear, Paul, is I don't want a clean sweep. I don't want the conclusion being where inflation is going to rise and therefore the interest rate cuts, which I think should power stocks in 2025, that could be taken away. If that's taken away, that would be a real disappointment from the US election.
Yeah, look, it would be, Pete. I mean, I think there's another fear as well, is that we just don't know the outcome. And one of the reasons for that is that some of the states, in some of the swing states, won't count the early votes for some time after the poll. Yeah. And you could be held in the situation where you don't have a clear outcome for some time.
And Donald wants to contest the number of states even before the count.
He wants to contest that, whereas some states are actually allowed to count the pre-polls beforehand. Yeah. And so you'll get the full result on the, as soon as they produce the first results, you'll see that you won't have the people who voted on the day, but you'll have actually all the people who voted in the 2 or 3 weeks leading up to it. Yeah. So, but I think Wednesday, could be interesting. So our market will just follow the US.
Yeah, without a doubt.
I think the most likely outcome is that the market in the US will sell off a little bit, just because I think it's bordered on Trump. So therefore there's more risks that something goes astray. Yeah.
And if it's 50-50 and we don't know for a few days, that will probably make market nervous.
The market's a little nervous because they'll, I'm not saying the fund managers and the deep institutions will do a lot of selling, but the traders will, just to play it down. Yeah. And take it lower. So it's a slightly risky time, I think, for investors just the next few days to look at.
I like the data from last week, Paul. The job market wasn't as strong as expected, which means you're not worried about boom creating inflation, and the PCE, which is the personal consumption expenditure index, which is the one that the Fed thinks is really important for inflation, came at 2.1%. It seems like that the Goldilocks scenario is looking good. Now, I just hope the US election doesn't ruin that Goldilocks scenario.
Yeah, and we also have the Fed meeting this week as well, where the market, by and large, expects rates to be cut by another 0.25%.
Yeah, yeah. So do you think the rotation play that you and I have been supporting, and also we've got some reasonably good Chinese manufacturing data as well, and our rotation theory is the miners do well because of China. The big caps have done so well, will eventually be sold off, not terribly, but sold off, and we buy other stocks that benefit from lower interest rates. Do you think it's still in place?
I think it is in place. There's also a bit of evidence to support that we've actually seen it sort of starting to happen a little bit. So in the month of October in our market, people forget the US for a moment, small caps actually went up in the aggregate, whereas the rest of the market went down. Not a lot. So
that's a good early sign.
I think the small ordinaries was up 1%. The overall market was down about 1.5 or just under 1.5. So we've seen a little bit of movement into small caps. And I think it's, it's partly a function of interest rates will come down here, which should help, but also the big caps are pretty expensive, right? I mean, how much higher could some of the banks go? How much higher could some of the companies like
Wesfarmers
or Aristocrat Leisure or some of the companies that had pretty big runs, or even some of the big tech companies, WiseTech, for example, how much higher can they go? So I think the market is struggling to find a lot of value, and so it is looking a little more widely, and we're seeing that a little bit of movement. So I think the rotation play is still in place because I think it's going to be hard for the big caps, in particular the banks, to keep heading too much higher.
Okay. Well, that's Paul Rickard of the Switzer Report. And coming up next is an interview I did last week with Ryan Quinn, who is the client portfolio manager for WCM. Now, WCM is a US-based company, but they have two products listed on the Australian stock market. One's called WQG, another one is WCMQ. Both have done really well over the last couple of years. And the interview with this guy is really interesting. One of their major holdings was Novo Nordisk, is the company that does Ozempic diet drugs. And they're quite famous for picking out companies of the future. They did it about 7 or 8 years ago with Shopify, which no one had heard of until this company really became famous over the period before the coronavirus crash in the market. So interesting interview with Ryan Quinn coming up. I'm talking to Ryan Quinn. Now, he's the client portfolio manager at WCM, which is a US-based fund manager. And they have two products on the Australian stock market. One is called WCMQ, which is more like an exchange-traded fund. And they have WQG, which is a LIC, a listed investment companies. Both have been performing very well. And I want to see what he sees happening in the future and how are they going to keep performing as well as they have been in the past. Ryan, thanks for coming to the program.
Very happy to be here.
Okay. I know it's a very hard thing to predict how well you're going to do in the future, but that's what people out there want to get out of an interview like this. So we'll see if we can get there. Just for the sake of people who don't understand, you guys are based on the West Coast. I've always tried to portray you guys as people who surf most of the time but come out and make fantastic investment decisions. It's quite a heroic kind of imagery, but it's not necessarily true. Some of you might surf, but the bottom line is, what is WCM's style of investment that explains its success over the last probably 10, 15 years?
Sure, yeah. I mean, look, I think there is some validity to the fact that we are in Southern California. We're outside of the major financial hubs of the United States or frankly anywhere. And that allows us to really think differently. It gives us a perspective on markets that is not really polluted or clouded by competing firms, competing analysts. I mean, when we go...
Which you might find on Wall Street.
Exactly right. I mean, when we go pick up a cup of coffee, we're surrounded by tourists and artists and the like, not other analysts saying, did you buy this stock? Did you sell that? You know, that kind of noise can creep into your mindset. And so the decision to be where we are has been very intentional to allow that clarity of thought, to allow us to really have conviction in our ideas without any other external, whisperings kind of sleep in and try to really change the way we think about things.
You're US based, but you don't necessarily buy all US companies, though I think that the major proportion are. But in a sense, you go searching for the best of breed companies anywhere in the world.
Exactly right. Our process is well, let me take one step back. The way we like to manage portfolios is in a concentrated manner. So in this global portfolio, we're typically 35 to 40 stocks. And so that means picking 35 to 40 stocks from everywhere in the world allows us to be very selective. And we do have a growth bias, so we're going to typically be overweight areas like technology and healthcare, which are the leading growth sectors in the market. And conversely, we'll be very much underweight areas like utilities or real estate, materials to some degree. So the portfolio is very consistent over time with high conviction. It's very consistent in the pools that it plays in. And then we try to have a balance in that portfolio and make sure that it really can perform throughout any sort of market environment.
Yeah, you try to reduce the downside, don't you? Which is not always easy. And I've got this chart here. And what you can see is a 5-year view. And you guys have only been in Australia about 5 or 6
That's
years,
correct,
haven't
yeah.
you? And what we can see is that if you start from there and you ignore the hump in the middle, it's been a really nice ride up. Explain the hump.
Yeah, so our long-term view allows us to have kind of a very differentiated view than the rest of the marketplace. So anytime we're buying a business, we're expecting to hold it for 5 years or longer.
Yeah.
Sometimes the thesis will play out a little more quickly, which will lead to greater turnover. But really what's going on is we have a very high conviction long-term hold portfolio that we're managing at all times.
Yep.
And then there's the rest of the world that we're also doing work on. And so when we get periods of volatility, we don't just ride our portfolio out. We'll always seek to upgrade the portfolio because in market volatility or drawdowns, in many cases, great businesses get sold off for really not fundamental reasons.
Yeah, because the markets are so scared, they dump everything.
Exactly right.
And the coronavirus was a classification.
And so historically, we've done very well on the market downside, and that's by owning high quality businesses, not relying on leverage for growth. But in 2022, for example, it was impossible for us to perform. But what we did in 2022, and similar to 2020, which we can see here, both very dramatic drawdowns, we sought to upgrade the portfolio.
Yeah.
Anything that was in the portfolio that might have gotten kind of close to its thesis could be replaced with something that we're getting an incredible market opportunity to buy.
Yeah.
In 2020, you can see we bought companies like Lululemon and Mercado Libre. These were thrown out thinking that coronavirus was going to kill these businesses. Yeah. And much of what was done here is responsible for what happened here. So what you can see kind of consistently, and I'm certainly not going to guarantee forward performance, but in those periods of volatility, we take advantage of it. We get excited about periods of volatility, which you can see here was a difficult year for the portfolio, but what's been driving the returns of the last 18 months, the top 5 stocks that have driven this last 18 months performance have been things that were bought in this period.
Yeah, and one of them, of course, is the famous Novo Nordisk, the maker of Ozempic, the diet drug.
That's
the
right.
Diet drug, which apparently a lot of Americans are using. You're clearly using it.
Twice a day.
Everyone in California is using it. All right, but what also I think is interesting about this is this is when interest rates just went through the roof in the US, and tech companies were basically rejected. Even the Magnificent Seven were for a while, but they then started to recover quicker than most, and they wouldn't buy anything else but the Magnificent Seven. And of course, that was a time where you guys saw there was value and you picked up. When did you start buying Novo Nordisk?
So we bought Novo Nordisk in 2019.
Okay, so it's been a slow burn.
We did buy
until it really went on fire.
We really loved the drug, that business when it was purely an insulin regulation drug, when it was just for diabetes. Yeah. We knew that the side effect was weight loss, and we knew that Novo Nordisk, having a culture of research and development, was looking into ways to privately label that Ozempic as Wegovy, which is their weight loss drug. So what happened in 2023 really was these GLP-1s, these peptides that they create that help manage the insulin, were almost as big a story as AI. Why? Because in medical testing, they were seeing that using Ozempic or Wegovy not only had that positive outcome of managing insulin, also with some weight loss, which is positive for diabetes patients as well.
Yeah.
But there were positive effects in cardiovascular disease. So there was fewer incidents of negative cardiovascular events like heart attack and stroke. And there was also a separate study that had very positive effects on kidney disease. So,
and of course sleep apnea as well.
and exactly.
And poor old ResMed copped it for a while until they realised that ResMed still had a decent business ahead of it.
That's true.
Yeah.
There have been a number of industries that have sold off because of fears of GLP-1s. We took advantage of one of those in that there was a company called Intuitive Surgical that has a robotic surgery arm that we really think is the future of surgeries, but we hadn't owned the business. The stock fell off 30% because of GLP-1 fears related to their bariatric surgeries, their stomach surgeries.
Yeah.
But what we knew was that those surgeries only contributed a very small percentage of revenues, like a small single-digit number.
Yeah.
And even if that number went to zero in the most draconian way, then the stock should not have fallen 30%. So in terms of when I say we upgrade the portfolio, we had an opportunity to buy that incredible business on a 30% discount purely because the market misunderstood the impact of GLP-1s on that industry.
Also, that the rise out of the interest rate drop there, or the impact of the interest drop, AI must be in there, because you guys have always been on the cutting edge of new technology businesses and AI, and probably AI is being exaggerated, but there are going to be some businesses that when they haven't even identified one day will be great beneficiaries. That's what you guys have been looking for, I presume.
Absolutely. I think what we recognized in this area here was that our exposure in technology was predominantly in e-commerce and semiconductor related businesses.
Shopify was one of your famous ones, wasn't
Exactly
it?
right. And so what we did in this period, knowing that it would be a prolonged rate hiking cycle, we'd have a lot of opportunities to do it. We wanted to add some businesses relating to cloud computing as well as enterprise software to diversify our technology sector bets.
Yeah.
And I'll say, as it relates to AI, we purchased NVIDIA in 2023, and that's not the only way we're getting exposure to AI. I mean, owning Taiwan Semiconductor in this portfolio, they're going to make 90% of the chips related to AI anything.
Yeah.
So you own the foundry, you're getting AI exposure.
Yep. Which has always been your picks and shovels approach to a lot of this stuff.
Exactly right. I'll do you one better. I mean, when you look at what's happening with AI, it's going to create a ton of electricity demand, which is going to increase the use of solar and wind. And so we own a company called GE Vernova, which we think not only is good for just the energy and the grid as a theme, but it also has an AI bent to it as well.
Have you taken any risk on nuclear?
Not direct risk on nuclear. I think the energy sector, similar to the financial sector, is evolving. Energy sector isn't just about a rig in the ocean drilling for oil. No. It's a much broader business offering than that. So we spend a lot of time, even though we have not much exposure there, we research those areas quite a bit.
Let's talk about the big macro issues that you guys often look through. I know you, in your younger days, you kind of dismissed the impact of recessions and interest rate rises, but the market can be stupid, but you might be intelligent. If you take out all those sell-offs and put the lines through, that's the intelligent approach to the guys at WCM. But the real world comes in sometimes and they overreact. But as you say, it creates a buying opportunity. But it means that the investors have to tolerate times when you don't look as smart as you usually do. And I think a lot of people who've hung in there have been really happy with the rebound of WQG in particular. With an election coming up, do you guys ever do any analysis of whether Kamal is better than Donald?
I think that when we look at our portfolio, this is where owning 37 stocks at the moment is a benefit.
Yeah.
Because you can look at each individual company and say, okay, no impact, no impact, no impact. And maybe there's some of our healthcare names, if they're related to drug pricing, they might have some sensitivity. But it feels like this election cycle, different than the 2016 cycle when Trump last ran, the market sort of understands what they're going to get a bit more. It seems to be handicapping, the race at the moment. Things can change, but if it goes one way or the other, I think there'll be less of a surprise or a reaction from the market than we did see in 2016. Donald Trump's first presidency came with, it was termed a Trump rally. That was not necessarily great for us because financials and energy stocks went really well. International, specifically Latin America stocks fell very badly. So those were somewhat surprise reactions. I think, regardless of who gets in, I think that the firm and the team, we're not necessarily expecting very much of a wild change in markets. The other kind of international hot button would be, how China's performing or what our relationship is with China. And the existing president, he was really pretty tough on China. I mean, Joe Biden had tons of different tariffs and limitations on what could be sent over to China. And I think that even if Donald Trump gets in, or frankly, if Kamala gets in, that tough stance probably will continue. And so, that's something that won't surprise.
Yeah. So you haven't gone through your portfolio and done a tariff test. Yeah.
No, but we do have exposure to high tech businesses that sell into the space. We recently sold Louis Vuitton, which was one of our favorite long-term holdings, based on the weakness of the Chinese consumer. And part of it has to do with tariffs, and could kind of extrapolate a few of those things. But certainly concern over the economic health of that country, which extends into the economic health of the consumer, does play into a number of our businesses, which are global in nature.
Yeah. What about the Trump tax cuts? The suggestion is that Kamala Harris wouldn't renew them. Is Trump talking about sustaining them, or would they end even under him?
I think we haven't spent too much time worrying about those tax cuts, probably because we focus, as it relates to the consumer, on luxury, which tend to, tax hikes and cuts tend to either annoy or delight, right?
Yeah.
But it doesn't change the aspirational quality of the good.
It's something good about the rich, isn't it? They just keep on buying.
That's right. That's why we own Ferrari.
Yeah.
And
we still got Ferrari, because many years ago when you came on my TV show, I think you just added Ferrari to it. I think the argument was, well, how many businesses can have a 2-year wait for customers to get their product and they still buy it?
Yeah. They just announced the electric vehicle, the F80. They'll sell 799 of them off a wait list.
Yeah, it's extraordinary. So looking down the time tunnel, in a sense, we know that the Magnificent Seven have been ridiculous. Look, I guess NVIDIA, you understand why, AI and chips and all that sort of stuff. But a lot of people say, the American market is overvalued. But it seems to me maybe 7 or 15 great companies are really overvalued. But there's a whole lot of companies that are undervalued because they've been negatively affected because of interest rates. Are you guys trawling through some of those companies, or have you already trawled through them and think eventually when interest rates fall a bit more, these companies will come back in favour for the market?
We certainly pay attention to valuation across our portfolio. And there are certain companies, like, for example, United Healthcare or an AstraZeneca, we felt like were undervalued in the healthcare space. But we're also not shy about buying optically rich looking multiples in the short term, because remember, these are next 12-month multiples.
Yeah.
And if we can make the case that earnings growth will be stronger, if not more durable, in year 2, 3, 4, and 5, then that backward looking period will look actually pretty cheap, because it's a simple fraction, right? Price over earnings. If the earnings grows faster and better than everything else, then that 12-month multiple is a little bit less relevant. So I wouldn't say that low multiples is something we would screen and look for. It usually falls out of kind of the rest of the investment process. But I want to make sure that it's clear that we'll buy expensive looking businesses only when we have the due diligence behind it that says to us that competitive advantage is growing at such a rate that the earnings will surprise everyone to the upside, which means that we're underestimating, how cheap the company actually is.
Well, I first talked to you guys, must be probably 7 or 8 years ago. You talked about, you look for companies that have a growing moat. Is it becoming harder to find those sorts of companies, or are they there? It's just a matter of finding them.
No, because companies change over time as they grow. And there are times when, Ferrari is a great example, where their moat trajectory is growing because they made specific business commitments, right? They wanted to broaden their fleet of vehicles to include a 4-door vehicle as well as an electric vehicle. They've had expanded manufacturing capacity, and they made a conscious decision to really emphasize the more luxurious, the higher end of their offerings. That way, they're not only controlling what gets out to market, but they also control the demand off of that wait list. So when we find businesses like that that are going through those kind of changes, we get excited about adding them to the portfolio, and that'll happen across industries.
And I know you don't stress out about the macro outlook, but if you're forced to give a view on what's likely to happen over 25 and 26, do you have a relatively positive view, or do you have positive view for 25, but maybe 26 could be challenging or whatever?
I think what we're watching closely is, again, the health of China. That's really important. We continue to have significant violence happening between Israel and Palestine. We continue to have Russia, Ukraine. So I'd love to say that those two things get resolved or stopped one way or the other, just to give some clarity in the world. If we can get China to a soft landing, managing their real estate market, also strengthening their consumer, and then another kind of fun market to keep an eye on is Japan. As governance changes are happening within those companies, performing better, and then potentially a strengthening yen due to BOJ rate increases. That could change the outlook for a lot of businesses. But I think that when we bring it back to our actual portfolio, we have extremely high conviction on the competitive advantage growth of our businesses. We're very excited about the earnings potential. All of the returns that we've been getting in the last 2 years have been at the hands of earnings growth. We have not seen our multiples expand. In fact, they've actually contracted slightly. So from a multiple perspective, our companies have gotten cheaper, and yet their earnings have done a phenomenal job growing. So if we get rate cuts in the US and we manage a no landing or a soft landing, and we have businesses that have been able to durably grow earnings through this period, we're feeling good about the individual companies we have, and we feel really good about the overall themes that we have exposure to in this portfolio.
Ryan, great seeing you, mate, and long may you keep producing great results.
Thank you very much.
That's Ryan Quinn, the client portfolio manager at WCM, and the two products in the Aussie market are WCMQ and WQG. And that was Ryan Quinn of WCMQ, and that's the show for this week. Thanks for joining us. It should be interesting to see how the market reacts to the US election and who becomes president. And that, I'm sure, will be the subject of a lot of the stuff we talk about next week. Thanks for joining us. And don't forget, if you're not a subscriber to the Switzer Report, I really would like you to become one. Just go to switzerreport.com.au and follow the prompts there. Thanks for joining us. See you next week.